Have you ever felt that your hard-earned Naira deserves to do more? Maybe you have watched your savings barely grow, while others seem to find that secret to wealth. Maybe you have no savings at all. What if I told you there is a way to turn those Naira into shares of the world's most powerful tech giants? Imagine investing in companies that shape our daily lives, like Apple, Google, and Microsoft, and watching your wealth grow alongside them. But I know it is not easy. Investing can feel overwhelming, especially when you are looking beyond Nigeria's borders. Questions like, where do I start? Is it safe? And can I really make a difference with my investments? Might be keeping you up at night. Today, we are going to embark on a journey together. We will break down the top 3 US stocks, demystify the stock market, and tackle those burning questions head on. Whether you are a seasoned investor or just taking your first steps, this video is your guide to making informed, confident decisions. Stay with me till the end. You won't want to miss the opportunities waiting for you. First up, we have the iconic Apple. You know, the company behind the iPhone, MacBooks, and those sleek Apple Watches. But Apple is so much more than just gadgets. In the fiscal year ending September 2024, Apple raked in a whopping $391 billion in revenue, up from $383 billion the previous year. A fiscal year is like the school year, but for businesses and governments. It's a 12-month period that they use to organize and review their finances, including how much money they earn, spend, and save. Unlike the regular calendar year that starts in January and ends in December, a fiscal year can begin and end at different times. Even amidst a global tech slowdown, Apple shines brightly, especially in its services segment and premium hardware sales. Apple isn't just making money, it's making massive money. A gross margin is like the profit a business makes from selling its products after covering the basic cost to produce them. Imagine you are selling a pair of shoes. If you sell each pair for 2,000 Naira and it costs you 700 Naira to make or buy the shoes, your gross margin is the difference between what you earn and what you spend on making the shoes. In this case, it is 1,300 Naira. Gross margins help businesses understand how much money they keep from each sale to pay for other things like rent, salaries, and new projects. A higher gross margin means the business is good at selling its products for much more than it costs to make them, which is a sign of a healthy and profitable company. With gross margins above 46%, their services and premium products like the iPhone and Mac are cash cows that keep the profits flowing. And guess what? Apple has a healthy balance sheet with a low debt-to-equity ratio of around 2.09. Let me explain this further for those of us that do not understand. A balance sheet is like a financial picture of a company at a specific moment, showing what it owns and what it owes. Imagine you run a shoe store. On your balance sheet, you would list everything the store owns, such as the shoes in stock, the cash in the register, and the store building. These are called assets. Then, you would list everything the store owes, like money you borrowed to buy more shoes or bills you need to pay for electricity. These are called liabilities. The difference between your assets and liabilities is called equity, which shows how much of the store truly belongs to you. The debt-to-equity ratio is like a score that shows how much a company is borrowing compared to how much money the owners have invested. Remember your shoe store. If you borrowed a lot of money from friends or the bank to buy more shoes, your debt-to-equity ratio would be high. This means the store is using a lot of borrowed money to grow. On the other hand, if you mostly use your own savings to buy shoes and borrow very little, your debt-to-equity ratio would be low. A high ratio can be risky because if the store doesn't make enough money, it might struggle to pay back the loans. A low ratio is safer because the store relies more on its own money. They have smartly used debt to fund buybacks and dividends while still holding over $195 billion in cash reserves. Talk about financial flexibility. With nearly $109 billion in free cash flow in 2024, Apple has the funds to invest in research and development, acquire new companies, return value to shareholders, and explore exciting new ventures like artificial intelligence, augmented reality, and virtual reality. It's a cycle of continuous growth and innovation. Now, let us talk about Apple's moat. What is a moat? A moat is like a protective barrier around a company that makes it hard for competitors to steal its customers and profits. A strong moat has something unique that sets it apart from other companies in the same industry. Apple's moat is all about the ecosystem. Think about luxury or the best in class. Their product is a statement. Their integrated products and services create a seamless experience that keeps customers locked in. With one of the most loyal customer bases and the ability to charge premium prices, Apple stands tall in the tech industry. Looking ahead, Apple's dominance in consumer electronics and its expansion into services and augmented reality ensure it's here to stay. Innovation is in their DNA, making their survival odds very high. If you like this video, give it a thumbs up. Liking this video will go a long way in motivating us to find stocks for you. But I want to hear from you too. There's probably a US stock you have always wanted to invest in. Even better, which US stock do you believe could grow your money this year? Share your thoughts with us in the comments below right now. Next on the list is Alphabet, the parent company of Google. Think of it as the wizard behind your favorite search engine, YouTube, and a whole lot more. Alphabet reported revenues of $307 billion in 2023, primarily from digital advertising through Google Search, YouTube, and Google Ads. They have also seen significant growth in their cloud business and artificial intelligence ventures. With gross margins above 56%, Alphabet's scalable advertising model keeps the profits soaring. Plus, their cloud and YouTube operations keep those costs in check. Alphabet boasts a very low debt-to-equity ratio of around 0.1, showcasing their strong financial health and ability to fund operations without relying on external debt. Generating over $69 billion in free cash flow annually, Alphabet has the resources to reinvest in cloud computing, artificial intelligence, and even autonomous driving. It's all about fueling future growth. Alphabet's moat is built on its search dominance, unmatched advertising network, and rapidly expanding AI and cloud capabilities. With over 90% of the search market, Google is a titan that's hard to topple. Alphabet's entrenched position in search, advertising, and its growing cloud and AI presence make its future exceptionally secure. Diversification ensures it thrives long-term. If you enjoyed this content, make sure to subscribe to the channel. Next, we have Microsoft. From Windows to Office, and now artificial intelligence and cloud, Microsoft is a true tech powerhouse. For the fiscal year ending June 2024, Microsoft generated $245 billion in revenue. Their strong contributions come from Azure, Windows, Office, and gaming through Xbox. With gross margins around 69%, Microsoft's recurring revenue model in software and cloud services keeps their profitability soaring. Microsoft maintains a very low debt-to-equity ratio of about 0.3, highlighting their strong financial position and ability to fund growth without excessive debt. Generating over $74 billion in free cash flow, Microsoft has the cash to invest in research and development, make strategic acquisitions like LinkedIn and GitHub, and return capital to shareholders through dividends and buybacks. Microsoft's wide moat is built on its enterprise software dominance, leading cloud platform Azure, and a robust gaming ecosystem with Xbox. High switching costs and strong network effects keep customers loyal and engaged. Microsoft's diversification into cloud computing, artificial intelligence, and gaming ensures it's well-positioned for long-term success. Its dominant software business and continuous investment in future technologies make its survival odds very high. Each of these giants brings something unique to the table, from Apple's unmatched ecosystem to Microsoft's AI and cloud leadership. For Nigerians like me, these stocks offer a mix of stability, growth, and innovation. But remember, investing always comes with risks. It's crucial to do your own research and consider your financial goals before diving in. If you found this breakdown helpful, give it a thumbs up, subscribe for more insightful investment content, and hit that notification bell so you never miss an update. Until next time, happy investing. Cheers.